Hello students, this is Dr. Himanshu Gupta, Assistant Professor in Finance from MBA Department, IIMT College of Engineering, Greater Noida. Today we are going to learn about portfolio management. What is a portfolio management? What is the need of portfolio management? Why the portfolio is being built? And what is the benefit of portfolio management? And what is the basically portfolio it is? Today we are learn these are all aspects. Okay, let's start. First of all, we understand what is the portfolio management in terms of its introduction. First of all, we have to understood what is the portfolio. Portfolio is a collection of financial investments like stocks, bonds, commodities, cash, and cash equivalents, including closed-ended funds and exchange-traded funds, etc. That means portfolio is a collection of financial investments. The investment may be stock, maybe a bond, maybe a commodity, maybe a cash, maybe a cash equivalent. When these are all securities are collected for making investment, it is called portfolio. That means any investor who having a money, if he distributes its money in all these stocks, all these bonds, all these commodities, all these cash and cash equivalent collectively, then it will be called a portfolio. That means portfolio comprises of securities, more than one security. If you having an investment in more than one security, that would be called a portfolio. Okay. Now next, then what people generally believe, what is stock, what is bond, what is cash? Cash, as you know, cash is a liquid form, that is a means of exchange. And what is stock? What is stock? Is a security, bond is a security, yeah, which are listed on stock market. Okay. If you want to make an investment in such type of securities, not in a single security, it will be called portfolio. Okay. So there can be a wide range of assets in terms regarding real estate, art, and private investment. Collectively, we can say that portfolio is a bundle of securities in which every security has different type of risk and different type of return. Okay. I hope so you understand what is the portfolio. Now come to the next slide. What is the portfolio investment? Here, look, in previous slide we have understood about the portfolio. Portfolio comprises of many type of securities. But what is the portfolio investment? That means you have your money invested in various type of securities, and collectively these securities is called investment because you have made your money into that. If investments are made in a group of assets or the securities instead of a single asset, they are called as investment in the portfolio investment. What is the type of portfolio investment? There is a four type of portfolio investment. Your portfolio investment comprises of either stock, either bond, or a portion of stock and bond, a collective form of stock and bonds. Any investment which having some part of stock and some part of bonds is called portfolio investment. This can be four types: risk portfolio, low risk portfolio, medium risk portfolio, and the high risk portfolio. See what is there. If you want, if you don't want to take a risk, You will invest in those type of securities which are risk free. That is called it is bank investment, FD, fixed deposit, government securities. These are those securities which are risk free. And when you include these securities in your portfolio, that portfolio will be called a risk free portfolio. Such type of portfolio have been made by those investors who don't want to take a risk and they want to minimize their return, minimize their risk, and maximize their return. And next one is a low risk portfolio. When any investor want to take a low risk because he want to take a uh, high return as compared to a risk free return, he would go into that. In low risk portfolio, those securities which are basically low beta, either you can say a defensive beta. That means securities that having a low systematic risk as well as low unsystematic risk would be called a low risk securities. And any investment, any portfolio which have been made from these type of securities would be called a low risk portfolio. And next level, there is a medium risk portfolio. Medium risk portfolio is comprises of those securities which having high risk as compared to the low risk portfolio. And accordingly, in this portfolio, you get high return as compared to a low risk portfolio. Okay, and accordingly, if you are making investment in those securities which having medium risk, such as which are uh, government companies like SBI, LIC, etc. These are those securities is having a medium risk. It's having a medium risk. Accordingly, a portfolio which comprises of these securities would be called a medium risk portfolio. Okay. And next one is a high risk portfolio. What is a high risk portfolio? Any person, any investor who having made their investment in those securities which having a high risk. That means the volatility of the return in those securities would be high. In terms of you either can say the standard deviation of these securities would be very high. Accordingly, you would get high return into that also. Accordingly, those securities which those securities which having high risk and these securities has been made into a portfolio, that portfolio would be called a high risk portfolio. Okay. Now, the example of such type of portfolio you can say like you talk about the securities. These securities all belong to small market cap. Okay. Now come to the next slide. Then, what is the portfolio management? What is the exact definition of portfolio management? The art of selecting the right investment policy for the individual in terms of minimum risk and maximum return is called a portfolio management. In other words, portfolio management refers to managing an individual's investment in form of bonds, shares, cash, mutual fund, etc. so that he earns the maximum profit within the stipulated time frame. Portfolio management refers to a managing money of an individual under the expert guidance of portfolio manager. It is also an art of managing an individual investment. See, why we are making a portfolio management? Because when we are making our money into a particular securities, we want that we can gain high return in turn of lower risk. Portfolio management would minimize your risk at lowest as possible. possible, and you maximize your return as maximum as possible. And accordingly, as I already said, that portfolio management would comprise of bonds, shares, cash, mutual funds, and the composition of your portfolio would be changed according to the market up and down in terms of their returns. You have to gain a particular return within a specific time frame. You can take a expert guidance of portfolio manager because generally such type of guidance has been made by the expert who are long experience in such type of portfolio management in stock market, etc. Okay, to the next one. Need a portfolio management. Why you are making portfolio management? Why any particular individual is making portfolio management? See, every person has some earning for their survival, and he just saving a uh, little amount to accomplish their target in a future. His target maybe likewise his target is maybe he want to make a big house in the future. He want to marry his daughter in the future. Accordingly, he want to make amount after 10 or 15 years to move to make anything which for which he want to earn the money. Then their saving which he continuously taking from his income, is saving from his income. That amount would be invested in some securities, so it can be grow over the period of time till till complete time in which you want to gain a return. So according to the your age, your income, your budget, you can create a portfolio. Okay, portfolio management minimizes the risk involved in investing and also increases the chance of making profits. Portfolio managers understand the client's financial needs and suggest the best and unique investment policy for them with minimum risk involved. Portfolio management enables the portfolio that provide customized investment solution for their clients as per their needs and requirements. Accordingly, the overall objective of portfolio management is to minimize the risk and maximize the return on your investment based on your income, budget, and your age, and your ability to take up. Now come to the what is the type of portfolio? There is a different type of portfolio management: active portfolio management, passive portfolio management, discretionary portfolio management services, and non-discretionary portfolio management services. See, you can invest, you can build a portfolio with a different type of approach. First of approach is active portfolio management. That means you will remain active in a stock market to to monitor your portfolio with security to be beneficial for you and which are not. In passive portfolio management, you are not actively monitoring your portfolio in a stock market. You just want to make a long-term return. You want to consistent return. And the third one, discretionary portfolio management, is when you are giving your entire money to some other person who will make a portfolio for you, and he will continuously monitor your portfolio, and he will change the composition of your portfolio so that you can achieve your target return within a right framework. Then that portfolio will be called discrete portfolio. And non-discretionary portfolio management में what is there? There is a when you are managing your portfolio your own. You are managing your portfolio your regarding you are not giving your time money to some other person. You are taking only expert advice from them. When you having such type of approach, your portfolio management would be called as a non-discretionary portfolio. Now we just understand these whole type of portfolio in detail. Come to the next slide. So look, what is the active portfolio management? It is the aim of the active portfolio manager is to make a better return than what the market dictates. That means in active portfolio manager would always go for a high return as compared to the market return. That is why he buy a stock when they are undervalued and start selling when they are climbed above the norm. Okay, and the portfolio manager plays a very important role in this approach. As your manager would be consistently and actively scanning the stock market in order to find the best investment stock market. It involves high return but high risk. See, active portfolio management is continuously monitoring the stock market. He looks into the stock market which securities providing high return and which security project low return. He built his portfolio from that those securities which providing a high return at a high rate. But he managing somehow so that these securities cross the risk, cross the risk among them. So you would get a high return, but you have to take high risk too because you are making your investment in those securities which having a high risk. The unsystematic risk can be deducted, but systematic risk cannot be deducted in this system. So the big question, should you go for it? Well, if you are someone who is not afraid of taking risk and wish to gain a big return on your investment, then such kind of approach would be suitable. Otherwise, you should go for passive portfolio management. So, collectively, if you call active portfolio management in one line, we just say in active portfolio management, in active portfolio manager continuously busy in monitoring the stock market and selling stock market and including those securities in its portfolio which are undervalued and selling those securities from their portfolio which are overvalued. That means composition of portfolio is continuously changed to gain a high return. But accordingly, we will take a high risk too. Okay. Now just move to next slide, which which is of passive portfolio management. What is a passive portfolio? If you understand the active portfolio management very well, you can automatically understand the passive portfolio management. Why? Because it is a vice versa of passive portfolio and active portfolio. Passive portfolio management is exactly opposite of passive portfolio. In active portfolio management, where you are continuously monitoring the stock market uh, to gain uh, to gain a higher return at a high risk, you are continuously changing the composition of portfolio so that the security which providing high return would be included in a be included in a portfolio and selling those securities from a portfolio which are providing lower return at a at a relatively high risk and that's why. But in a passive portfolio, you would made you will make investment in those securities which having a low turnover, but their growth is long term, consistent. long with consistency. In these portfolio managers believe on an efficient market hypothesis theory. They think that the price of any security would reflect the fundamentals of company. What is the fundamental of company? Fundamental of company what is the earning per share of the company? What is the book value per share of the company? What type of contract has been achieved, has been obtained by the company for the future, which would provide higher profit to the company? What is the going concern possibilities of the company? What is the financial risk of the company? What is the uh, operating risk of the company? These all fundamentals are considered by passive portfolio manager, uh, uh, portfolio manager in their thoughts with that the price of the stock would reflect all these fundamentals. Therefore, the passive manager prefers to a dividend index fund which have a low turnover but good long-term growth. Here the growth yield is slow, but they generate consistent yield in long term. Because in spite of that, in addition to that, the cost of implementation of these portfolios is also low. That is why if you are beginner in stock market, that either you are starting your portfolio uh, build recreation, that I would suggest you that you have to first of all build a passive portfolio, and after which you can start active portfolio. Because for learning state it will be better for you that passive portfolio management services would be given, yeah, would be obtained by you. So accordingly, what is an active portfolio management? You just monitoring continuously stock market to get high return. In passive portfolio management, you are not continuously monitoring the stock market. You have just at one point of time you have just make an investment in some securities which have good fundamentals in the long term, and you will gain a consistent return over the period of long term period. Okay, now come to the first. What is the discretionary portfolio management? Discretionary portfolio management. See, as the word suggests, discretionary means you can do anything from your phone. In this type of portfolio management investment, funds are placed with a broker or manager who has discretion to invest them on the client's behalf. That means securities which have been included in portfolio is not included by you, is not purchased by you. You have given your money to any other broker, and such broker is managing your portfolio. He is investing your money on behalf of you, and you are not continuously suggesting him what securities to be included and what is not to be included. Here, the investor only has to invest money because he has no time. Once you communicate your goals and respective timelines to your manager, rest is taken care by you. That means you have to communicate your portfolio, discretionary portfolio manager, your goals, what type, how much money you want in a future. That means after some point of time in a future. Accordingly, your portfolio manager to gain that return, he will change the composition of your portfolio so that your portfolio gain that return within that time framework that you have given to your portfolio manager. Your fund manager would do all the heavy lifting whilst you will enjoy profits. Okay? Only go for this approach if you don't have a lot of time to be here for sale and purchase of every single stock and don't want any stress. That means if you because you are giving your money to any other person to build a portfolio, and he will manage your portfolio because you don't have time, you don't want to take any steps, but you have in turn of that you have to give a cost, you have to bear a cost of that person who are managing your because you are not giving your time in managing portfolio, and you even you are not interested in managing a portfolio. That is why you have given your money to any other person to build a portfolio. But there's a one thing that if you are trusting someone else, uh, require a lot of calculation, and if he could write, he could done right, and could be one of the best decision if he were right. But if he had been wrong, he wouldn't have. So if you believe someone's knowledge about the stock market, about the securities, only in that situation, discretionary portfolio management can be done. Otherwise, it could not. Now, come to the next. What is the non-discretionary portfolio management? See, if you are not ready to hand over your entire portfolio responsibility to someone else, so today you can start with non-discretionary portfolio, where your manager basically acts as a counselor and advises you based on the current market and your future goals to the best of his or her ability. That means you have given your money to someone in discretionary portfolio management, but in non-discretionary portfolio means you are not giving your money to someone to build a portfolio. You are building your portfolio your own yourself, but you are taking someone advice to change the composition of your portfolio. That means which securities to be included in your portfolio, which security would be excluded in your portfolio. You are taking advice in this respect from any outsider who is an expert in stock market. Okay. Accordingly, your future goals would be accomplished with the ability of such expert because he would advise you based on the current market. What is the trend going in the current market so that you can build your portfolio, you can manage your portfolio efficiently. To follow through on advice would completely to be your own decision. Whether you decide to use a portfolio manager advice or not, it depends upon yourself. Whether you have to choose his expert advice or not. That means if you are choose the expert advice on the market, your future goals would be depend upon your future return would be depend upon his ability. Okay, so ensure that it is put forward in a logical way. I hope so. You have understood about the these four type of